What if I told you that one of the most powerful and secretive institutions in the United States was born in a hidden meeting on a secluded island?
In November of 1910, the heads of the most powerful banking institutions in America boarded a private railroad car in New Jersey.
An institution that now controls the nation's money supply, sets interest rates, and operates with almost complete independence from government oversight. I'm talking about the Federal Reserve. Today, we're diving into how the Fed was born, why its role is so controversial, and whether it serves the public interest or the financial elite.
The Fed represented wonderful hopes, but we've had so many programs that represented wonderful hopes that ended in disaster.
Let's start by going back over a century to the year 1907, a time of severe financial panic. Banks were failing, people were losing their savings, and the public demanded reform.
We'd had a number of these crises on a fairly regular basis since the end of the Civil War, and the financial panic in the fall of 07 and the really terrible fallout from it in 1908 led to a number of proposals that ultimately ended up in establishing the Federal Reserve in 1913.
To fix this crisis, Senator Nelson Aldrich, backed by some of the country's most influential financiers, organized a secret meeting to discuss a new system. The location? Jekyll Island, Georgia. And the guest list? Only the elite of the banking world, including representatives from institutions like J.P. Morgan and Kuhn, Loeb and Company.
The meeting was arranged by J.P. Morgan, yes, that J.P. Morgan of the investment bank notoriety. And the attendees included Henry Davison, who was a partner at J.P. Morgan, Frank Vanderlip, who was a partner at a Rockefeller-owned National City Bank, Paul Warburg, who was a partner in a large investment bank, also Nelson Aldrich, who was a senator and member of the Senate Finance Committee, along with his assistant, and A. Fiat Andrew, who was then Assistant Treasury Secretary. So you can see a lot of influence by big bankers.
Picture this. It's November 1910, and these powerful bankers are gathering under complete secrecy. They're only using their first names, traveling incognito, and even hiding the purpose of their meeting from their families.
It was important that no one, not even the servants on board the train, be allowed to know their last names. The destination was Jekyll Island, a private retreat for multimillionaires, away from reporters and prying eyes.
What were they up to? They were creating a centralized banking system that would eventually become the Federal Reserve, a system designed to reduce competition among banks and stabilize the financial sector. But the Federal Reserve is neither truly federal nor a reserve. It's not a government agency in the traditional sense, as it operates independently from direct government control, and its 12 regional banks are privately owned by member banks.
Altogether, these 7 men represented one quarter of the world's wealth. So just highly concentrated amount of power and wealth.
Additionally, it doesn't hold physical reserves of gold or currency for backing dollars. Instead, it manages a fiat money system, creating currency as needed without any gold or commodity backing. Critics point out that they were forming a banking cartel, aiming to control America's money supply for their own benefit. This plan became the blueprint for the Federal Reserve Act of 1913, which Congress passed to establish the Federal Reserve System. But what made the Fed unique and what continues to make it controversial is the level of independence it was granted right from the start.
The Fed's independence has been called into question. Utah Senator Mike Lee calling for an end to the Fed. In a tweet he wrote, in his words, the executive branch should be under the direction of the president. That's how the Constitution was designed. The Federal Reserve is one of many examples of how we have deviated from the Constitution in that regard. Yet another reason why we should #end the Fed.
Once the Federal Reserve was established, it was structured to operate without traditional government oversight. Unlike most government officials, Federal Reserve board members are appointed for 14-year terms, and they can't be removed by the president or Congress simply for disagreeing on policy.
So, what was this Federal Reserve Act? What did it do? Well, it established the Federal Reserve as the lender of last resort, the lender of last resort for the U.S. banking system, meaning when a bank is in crisis, it can turn to this central bank for help. And the Federal Reserve would be in charge of managing the money supply.
This setup was meant to keep them insulated from political pressures. But it also means that neither Congress nor the president can hold these officials directly accountable for the economic decisions they make. So who is the Fed accountable to? The short answer is, it's complicated.
If the definition of central bank independence means no legislative oversight, if it means no limits on the financial capabilities of the Federal Reserve, and if it means no real accountability, the Fed often claims it has responsibility for stable prices, but nobody got fired after we had the worst inflation in 40 years.
And it doesn't stop there. The Federal Reserve doesn't rely on taxpayer dollars to fund its operations. Instead, it generates income from interest on government securities, giving it financial independence. Most of its profits go back to the U.S. Treasury, but this financial setup means the Fed can make big decisions without waiting for Congress to approve funding. In other words, the Fed can set monetary policy and control the money supply with very little interference from the government. Now, this unusual arrangement raises some big constitutional questions. The U.S. Constitution gives Congress the authority to coin money and regulate its value. So how did the Federal Reserve end up with these powers?
And notice the language here. The United States of America will pay to the bearer on demand $10. So this note is an obligation of the federal government. The United States of America will pay to the bearer on demand $10. Federal Reserve note.
The Fed operates almost like a private institution, with the 12 regional Federal Reserve banks being owned by private banks that buy stock in them and receive dividends. This quasi-private structure has led many to ask, is the Fed truly working for the American people or for the financial institutions it regulates? Now let's take a closer look at the Fed's track record in managing economic crises. The Fed was created to prevent economic instability, but its history is filled with turbulence. It's been at the center of some of America's most significant financial crises, from the Great Depression to the 2008 financial meltdown. Critics argue that instead of preventing economic downturns, the Fed has often made them worse.
Lots of questioners want to know whether you share Congressman Ron Paul's skepticism of the Fed. And now I'm going to quote you. This isn't in Basic Economics, but a recent column. Quote, "For most of the history of this country, there was no Federal Reserve System." There you go, that dirty trick of bringing in history.
Yes.
There was no Federal Reserve System, which was established in 1914 to prevent bank failures. But bank failures in the 1930s exceeded anything ever seen before the Fed was established. Close quote. If we could make you dictator, would you abolish the Fed?
Yes.
You would?
Yes. I mean, for the reasons I just gave, the history.
They say that by setting artificially low interest rates, the Fed encourages excessive borrowing, which creates speculative bubbles. And when these bubbles burst, the Fed responds by printing more money, devaluing the dollar, and fueling inflation. The ability to expand and contract the money supply at will is what we call elastic currency. The Fed uses it to stimulate the economy, but in the long run, it erodes the purchasing power of the dollar. This fiat currency system, where money is not backed by physical commodities like gold, allows the Fed to create money essentially out of thin air.
Well, should there be limits on how much government debt the Federal Reserve can purchase? Should there be limits on how much base money it can create with a computer keystroke?
While it can jumpstart the economy in the short term, critics argue that it leads to inflation and makes life more expensive for everyday Americans. And this brings us to another major criticism of the Fed, its tendency to shift the economic burden onto taxpayers. Here's how it works. When banks take big risks and get into trouble, the Fed steps in to support them. Sometimes this support involves bailouts funded by taxpayer dollars or by increasing the national debt. Over the years, the Federal Reserve has orchestrated some massive bailouts, each one revealing the scope of its influence. From rescuing the Penn Central Railroad in 1970, which led to the creation of Amtrak and over $100 billion in federal subsidies to date, to bailing out Continental Illinois in 1984 for $4.5 billion, and long-term capital management in 1998 with a $3.6 billion coordinated rescue. Then came the 2008 financial crisis.
John McCain said this is the worst crisis in the country since the end of World War II. Is it this bad?
I think it has the potential to be this bad because in the end, all financial transactions in all countries rest in part on confidence. That is, your local bank, for example, will insure your account up to $100,000 or a little more, but they are only required by federal rules and never have been required to keep more than a certain amount of, if you will, cash reserves, which is much less than it would take to cover all the outstanding obligations of the bank.
$182 billion for AIG, $700 billion for TARP, and over $1 trillion in emergency lending to banks. And in 2020, during COVID-19, the Fed intervened with an astounding $3 trillion in new lending programs. Each bailout reminds us of the Fed's role in propping up the financial system and the staggering costs often borne by taxpayers. And what is the result? Private banks get to keep their profits while the losses are absorbed by the public. This was particularly evident in the 2008 financial crisis, where the Fed's low-interest policies encouraged risky lending. When the housing market collapsed, the Fed orchestrated massive bailouts to stabilize the very institutions that contributed to the crisis.
The New York State Attorney General says that Citigroup, Merrill, and 7 other banks, which got $175 billion in tax-funded bailout money, paid out $33 billion in bonuses. The report by Attorney General Andrew Cuomo says that when banks did well, employees were paid well. That's okay. Cool. When they did poorly, employees were paid well. And when they did really poorly, they were paid well. Concluding that the bonus structure had no rhyme or reason, which is indeed the title of the report. As for the numbers, not a lot of sense there. He has a point, maybe. Goldman, Morgan, JPM Chase took in $45 billion of bailout funds under the TARP, paid out $18 billion in bonuses amongst them, and how much they make? Less than $10 billion last year.
In a way, the Fed operates like a financial cartel. Think about it. The concept of a cartel typically means a group of businesses working together to limit competition and control prices. The Federal Reserve does something similar by coordinating monetary policy among its member banks. Through its control over interest rates and the money supply, it effectively dictates the conditions under which all banks operate. This setup limits competition from smaller banks and centralizes power within a few major financial institutions, allowing them to benefit from their close ties with the Fed. Critics argue that this cartel structure serves the interests of big banks rather than those of the American people, making it hard for smaller banks and individual entrepreneurs to compete. Given these issues, it's not surprising that there have been calls to abolish the Federal Reserve altogether.
If people get very disgusted with the dollar in the financial system, and just look at what the dollar is doing right now, I mean, these recent announcements just devaluing the dollar. But we ought to have the right to practice free market economics and follow the Constitution, allow gold and silver to be legal tender rather than putting people in jail if they want to do that. If you want to look at what it might be like without a Federal Reserve, look to the latter part of the 19th century, early part of the 20th century.
Critics argue that true economic stability and prosperity could be achieved by returning control of the money supply to Congress, as the Constitution intended. Some reformers even advocate for a return to a gold standard or a currency backed by commodities, which would limit the Fed's ability to print money and control the economy. Such a system, they argue, would impose stricter limits on government spending and prevent the inflationary cycles we've seen under fiat currency. Supporters of the Federal Reserve, on the other hand, argue it's a necessary institution for managing the complexities of a globalized economy. They claim that the Fed provides stability in a way that no other institution could.
Hi, I'm Sebastian.
And I'm Helena. We work for the Federal Reserve, the central bank of the United States. One of the 5 key functions of the Federal Reserve is to supervise and regulate banks and other financial institutions to ensure they operate safely. While we all rely on these institutions for traditional services like savings and checking accounts, credit cards, and loans, they also play an important and increasingly complex role in the broader economy.
But critics maintain that the Fed's structure and policies put private interests above public welfare. They point to its creation on Jekyll Island, its independence from government oversight, and its quasi-private ownership structure as signs that it serves a select few rather than the nation as a whole. So what do you think? Is the Federal Reserve a stabilizing force in our economy, or is it a powerful institution that operates beyond accountability? Whether you see it as a safeguard or a cartel, there's no denying that the Federal Reserve has an immense impact on our daily lives. From the interest rates on our mortgages to the value of the dollar in our pockets, the Fed's influence is everywhere. If you enjoyed this exploration into the Federal Reserve, make sure to like and subscribe for more videos on the mysteries and power dynamics shaping our world. And if you want to dig even deeper, consider checking out The Creature from Jekyll Island by G. Edward Griffin. It's an eye-opening read that critiques the Fed's origins and operations in great detail. Thanks for watching, and we'll see you in the next video.